We want to make sure we're really, really, really tight on making sure the client is qualified for the market we're placing them in, because it's also going to help us control our loss ratio with the carrier. Hello, friends. Stephen Harrington Dakota, the diva of insurance with Agency Performance Partners, spending a couple minutes today talking about managing our loss ratios and what do we need to do to be more profitable and some things to think about and look at. So first off, for those of us that don't know, loss ratio is basically the amount of claims that are paid out on behalf of a carrier versus the amount of premiums brought in. So if you have a high loss ratio, a lot of times this can affect your relationship with your carriers, and they may not want to stick with us if we're not having profitable business. So we want to make sure that we are keeping our business healthy and happy, and there's a few ways that we can manage that effectively. The number one thing we need to do is educate our clients. A lot of claims are preventable with the right guidance, and not every claim should be paid. Just because there's coverage doesn't mean it needs to pay for it. So we really need to take time to talk to our clients, inform them of different factors or ways that we can maybe prevent some of that loss, and also how to be very proactive in handling some of those things. If the loss is minor in comparison to the deductible, there's no injuries or threat of further loss or lawsuit, they might just want to handle that out of pocket. A good example would be a fence falls over in a backyard. Might be a few $1,000s to fix it, but a lot of times we have percentage deductibles or these higher deductibles that are over the amount it would cost to repair the fence. So we really want to be taking a look at how can we educate our clients and help them understand that insurance really is for catastrophic losses. It's for those major one-offs. It's not for every little ding, crack, dent, whatever that may happen that there may be coverage for. And I think clients also really appreciate that kind of value-added service, and it helps build trust with them and with the carrier. This is tip number 2, and I will scream this from the rooftops. Review your underwriting practices. Don't place things that don't belong in places they don't belong. Simple rule. But a lot of times we try to squeeze our clients into wherever the rate is cheapest, or somebody really wants a carrier and we try to make them fit, and it's not the best fit for the carrier. So we want to make sure we're really, really, really tight on making sure the client is qualified for the market we're placing them in, because it's also going to help us control our loss ratio with the carrier. And the last thing is data. We want to make sure that we are looking for claims patterns, looking at different demographics of clients, and having a diversity in our book to where not everything is in one specific area or one specific class code or risk, so that we can diversify our risk and be able to really protect our loss ratio through spreading the risk across multiple types of categories. So all of this can go quickly and easily into lower loss ratio. I also would think we need to work closely with our carriers. We need to find out what it is they really want, what they're hot at, what they're looking for. And when we have those open and honest conversations, it helps us become more profitable as well. I look forward to talking to you again, and if you have any questions or if you need help at your agency, feel free to give us a shout at agencyperformancepartners.com.